Thank you guys very much, and welcome to the final panel of Marine Money Week. It's just been a pleasure to be together this week. Our final panel today is called Omar's Room, and I'd like those guys to please come up to the stage. When we started putting together the idea for sort of the final session, we were kind of brainstorming what that might look like. And we were like, wouldn't it be cool if we put like a bunch of really interesting people in a room with Omar? And that's what we've done. And the name kind of stuck. So Omar really needs no introduction. He's one of the great analysts covering the shipping sector. He's at Jefferies and has been in a few different firms over, must be 15 plus years of...
Yeah, 15.
He checked his watch. So really looking forward to that. And I want to thank Slorer for coming in last minute. Robert Bugbee was going to be on this panel, but he is not feeling well. So Oli is another great shipping analyst veteran, so we're happy to have him. And I just want to take this opportunity to thank all of you for the week, for being here. I hope you had a great experience. Hope you came up with some new ideas and made some new friends and did some business development and just had some fun. And I think most of all, whether you're a veteran or new to the industry, I hope you got a sense of just what a great business this is and what a great community it is, and really how fortunate we all are to be part of it. So thank you very much. I hope it was great. After this panel, I hope you'll join us for a glass of champagne before you head off to all parts of the world. And I wish you a great summer. We have a lot of Marine Money events in the fall, so in a couple weeks, if you get the itch again, take a look at the calendar, and hope to see you somewhere. So Omar, take it away.
All right. Thanks, Matt. Congratulations, by the way, Matt and Mike and the Marine Money team. Another fantastic conference. So well done. And yeah, happy to be moderating this panel. We've got, I think, an eclectic group of panelists here, a fairly unique one. I'll make a quick intro, and then we'll sort of dive into it. But I think the plan is to talk about investing in shipping primarily, both from investing from a ship owner's perspective and then also from just an investor's perspective. So I'll start from my left. We have James Mintzmyer. I don't think he needs much of an introduction. Value Investor's Edge. I've gotten to know you over the past 5 or 6 years. Very interesting approach to how you do your business, which I want to ask about in a little bit. We have in the flesh, I believe his name is Ed Finley Richardson. I'm not sure if that's his pen name, but he's what people would call an influencer on Twitter. And I've always wondered what that term meant. I didn't really know what to make of it, but indeed, you do have a lot of influence. And how many people come to me with your commentary and some of your nuggets that you post on Twitter.
I apologize for that.
Thank you. And then Slorer, obviously, big name in shipping, and one of the people that I emulated when I first came into following shipping. You had a 20-year career at Morgan Stanley, top-ranked energy analyst. Built up the BTIG investment banking practice in energy, and I believe is on preparing for his next voyage. And then Bob Burke, I think the definition of buy low, sell high, right? He's right there. So congratulations. You got Lemos, Onassis, Burke, right? So intros out of the way. Just wanted to maybe ask, first off, shipping. How did we get into shipping? What makes it interesting or compelling? Why are we in it? I want to start with Ed. What compelled you to get involved?
Volatility. As a trader, as a speculator, as an investor, volatility, I see it as an asset rather than something which I'm afraid of. And I think that shipping offers that in spades. And it just so happens that now we are blessed with an incredibly positive supply picture, which also gives us a tailwind. So that's my interest. And of course, it's a wonderful small community where everyone knows one another. So when someone comes out of nowhere, you can make waves, and that's fun.
Yeah. Do you invest in shipping directly, or are you just more of a knowledge provider?
I do. I'm very active. But what's interesting is that the more active I become collecting and disseminating information and exchanging views with people all around the world, the less trading I do, because my conviction level has really risen, and therefore I don't find it necessary to. I feel that if I'm well informed, I'm confident of my entry, it's much easier to just do nothing now. But previously I found I had the inclination to always be active, and I think that's one of the biggest dangers for anyone involved in shipping investment, is to want to use information coming in every day to act. And in fact, the best returns happen when you turn off the computer for a few years and go to the Greek islands. But no one can do that. It's too tempting.
Well put. Yeah. Jay.
We stole volatility. So everybody always thinks, you bring shipping up to everyone, no matter if you're a billionaire or a widows and orphans and grandmothers, has a story about how they got screwed by a shipping stock, right? It's got to be like one of the most hated sectors on the entire market. It's hard to do worse than that in terms of reputation in the common person. That, combined with volatility, are actually two of the reasons we love shipping the most. It is one of the most inefficient market spaces we have ever found. They're small cap names. They're too small for any of the big investment banks to get involved, for any of the big deal makers to play. And there's private equity, of course, but in terms of the public markets, they're just too small of companies. That is great for us. That gives us an edge. If we were researching something like Apple or Tesla or whatever, we would have no edge, and there'd be no way to outperform the market over time.
Yeah. Could you maybe just expand just a little bit on Value Investor's Edge? I've heard of it. I've obviously seen you for many years, but I got a quick intro from a couple of your clients, and I was a bit surprised at the process. Could you maybe just give a minute about what it is that you do there?
Yeah, certainly. So we are basically buy-side research is what it comes down to. Our entire business model is selling a research platform either per month or per year. So our clients range from retail investors, but of course retail is a misnomer, right? These aren't people with 50 shares or 500 shares. We're usually talking medium to high net worth individuals. So I think our median person, I don't know for sure, right? That's private business, but our median person's probably anywhere from 500,000 to 5 million. In shipping, but would still be considered retail, right? And then, of course, we work with family offices, a couple hedge funds, a couple private equity outfits, and they're just looking for a research service which is motivated by providing a quality product that they can sign up for. If they don't like it, they don't renew, right? They don't want to come back the next year. And so we've been around for 8 years now. And yeah, so it's basically the same as any other sort of bank doing a research shop, except the way we make our money is a little bit more different, right? The investors are paying us for the research.
Thank you. Ole, you've been involved in shipping for a long time. What keeps you involved?
Well, let me give maybe an opportunity to say how I got involved first, because growing up in Norway, we had fish. Oil had just started, and there was shipping. And my family had just lost a boatload of money in fishing, so that was not an alternative. And oil just didn't seem like much fun. And shipping had, amazing characters like the Bergesons, the Fredriksons, Hög. It seemed to be sort of the place to be. So I started out thinking that being a naval architect would be the way to go, but I think you can all be very happy that I gave that up very, very quickly, and pivoted to finance, and I just have loved it sort of ever since. It's an industry that just makes you meet amazingly crazy characters that are so different from any other industry you can think of, and I think the reason to stay with it, even if you're not purely focused on shipping, like I'm no longer purely focused on shipping, it gives you, not always, but sometimes it gives you amazing real-time insights into what's going on in the global economy that you can drive parallels to in other sectors. And I'll just leave it at that.
Yeah, no, well said. And it definitely feels like shipping has a front row seat to a lot of what's happening in the global macro. Bob, obviously, you've been involved in shipping for most of your career, basically. You had a big fleet. Are you officially out? Have you sold your last ship?
Yeah, no one's inviting me to parties anymore. No one's calling. My jokes aren't funny. Everything's changed just in hours.
So we lose the ship owner moniker for now. Are you staying in it?
First, I want to thank everyone for staying for the last session. If I wasn't here, I'm not sure if I would be out there. I'd probably be gone already. I don't know what that says about me or you, but it says something. No, I'll
It's
definitely.
a champagne.
Here is the champagne. Yeah, I mean, my whole life's been shipping. It's been my family on both sides, and I went to the Merchant Marine Academy, went to sea. It's really all I've ever known. But what everyone else said. I mean, the characters, international aspect, from a financial point of view, the operational leverage combined with financial leverage and the cyclicality, if you do it in a disciplined fashion, enables you to make a lot of money without being terribly smart, which is attractive to someone like me. And it's a good discipline to be able to get in and out. But it's hard to sell when the market's really, really high, because it's cool when it's really, really high. But I started in shipping shoreside because I went to sea for a bit in '85, and I have this theory that wherever you enter the business cycle is what you think is normal. And '85 was absolutely horrible. So I'm pretty comfortable getting in when it's horrible, and I'm not really comfortable when it's this high. Because for me, normal is really low. So when it's this high, I'm like, we got to get out because this isn't going to last. As we know, this too shall pass, and that means good times and bad times. But first, I have one question for Ed. I think the most useful thing for all of us here, I don't know about other people, but I have no idea what an influencer is. I know that Twitter's worldwide. Influencer is an important word, and we always talk about this industry needs to get our name out there in a good fashion. So when I hear Twitter influencer shipping, I'm like, maybe that's an opportunity. But I really don't know what an influencer is.
Well, normally they come with a lot shorter skirts, don't they?
That's right. I'm very happy to talk about that, especially because I wasn't the first person to give myself the title of influencer. It was the conference that put me down as an influencer. I thought that was really funny, so I didn't comment. I think that the way that the hierarchy of communication has changed and has broken down means that everyone can have an opinion, and that means there's a lot of noise out there. But it also means that if someone is providing more focused communication, it rises to the top. So what I've tried to do is provide a platform for other people to give their points of views. It may seem like I'm sharing information to make myself look good, but actually what I'm looking for is responses. And I think that if you're involved in shipping, as Jay pointed out, it's a little corner of the finance world which really doesn't interest a lot of people. Unless they're momentum traders and things are going well, but they tend to just disappear. And the people who are in it for the long haul and who are ready to educate themselves are few and far between, and they tend to not be in the same geographic location. So, for example, I live in France, and in France, almost no one is interested in shipping, and I can't talk to my friends about it. Even the people who are in finance, they have zero interest in any of these names or any companies at this conference. They couldn't care less. But I can connect with Jay, who's in Boston. I can connect with seafarers in Singapore or Mumbai. I have information coming from ship owners in Greece, from brokers in Norway, from an investment professional in Dallas, from an accountant in Hawaii. It's extraordinary. It's kind of like as if we were all obsessed with the same kind of rare cat breed or something. And it just brings people together. And I find that, first of all, I find that very fun and therefore engaging. And it also allows us to feel like we're on the same team, because when things are going good, we share that. We have fun together. And when things are miserable, we share that too. And I think that today's world, people need that sense of sharing. Otherwise, if you're just investing in these companies on your own, it's really boring, and it's really depressing when it's not going well. So I think that maybe the word influencer is a misnomer for my role, or for what I try to do. First and foremost is my own investing, but look, I'm on stage with all of you. A year ago, none of you have heard me, and I might just disappear in another 12 months, and it won't matter. But we're going to have a ton of fun in between now and then. And isn't that what it's all about? It's the voyage.
In this industry, yeah.
So I love that. I love meeting new people and sharing interest, education. There's some members of the audience who have been extremely generous with me with their experience, and I've been able to share things with them. And I find that extraordinary, in particular because I've never met any of these people. So it's great that that exists, I think. Social media isn't just about negativity and spreading violence or whatever. It's also about this kind of sense of friendship. So I love that. I've become addicted to it.
I don't want to speak for you in any sort of way, but I think the way that you're anonymous on Twitter and you use the fun profile pictures also gives you a nice little edge, right? Because you can actually speak your mind and you can say the things that a lot of people want to say, but because they have a business or because they have contracts or because they have clients, they can't say them. And we already have set the bar high earlier in the conference for sparks flying, so we won't maybe set the bar that high. But his Twitter account sets that bar almost all the time.
But my
So
partner
the
spoke
memes-
with mine this morning. Maybe Ed could get some of that out on Twitter.
Yeah, I think actually it's probably not a coincidence that that happened, because I think that that erosion of hierarchy or power is really part of the contemporary mores. I mean, this is the age we're living in, and I embrace that. I think it's fantastic. On the last panel, one of the last panels, there was a gentleman who talked about the fact that shipping still has a really bad reputation among investors, and that's true, but that can change. I mean, if people are held accountable for gifting themselves, let's say 5 or 6% of their own company via new shares and diluting the shares of everyone else, then we should be able to talk about that. Why not? And I do. And I sometimes get corrected. I don't get everything right, but at least we can talk about it openly, not pretend like it's not happening. And I find that, as Jay said, the relationships are so tight in this business. Even the journalists don't talk about it very much for lots of different reasons, but I don't have any of those connections, so I don't care. I will talk about it.
Perfect. And so we talked a bit about Twitter, and maybe just generally or broadly about social media in general and shipping. Do you think companies need to be using that more? Is there an effective way for companies to make money, investors to make money? I know, Jay, you're involved obviously with Twitter and other elements of social media. How do you see there opportunities aside from, Ed, you were talking about the camaraderie that's built up. Is there more to it? Can you uncover opportunities, maybe the herd mentality that shows up in those dialogues that then potentially how to invest?
Well, I think there's a balance to it, and I'm sure Ed has his views as well, but I think there's a misnomer when people say, I need to be involved in Twitter, or I need to be involved in social media. People think, oh, I need to be hyper promotional. I need to get on Reddit. I need to be attracting this weird sort of clique, this weird crowd. But there are folks who do all these things correctly, and one of them is not in the room today, and that's unfortunate, but I want to give a shout out to the CEO of Flex LNG, Oystein, who I think has hit the perfect balance between being very promotional of his company, but doing it in a very professional and correct way. And he has, the fun little merchandise, and it's so cheesy, right? But it's fun, and it's correct, it's appropriate, it doesn't cross any lines ethically, and he's built a bit of a, dare I say, cult following. And so I wanted to give that shout out and sort of mention that there's two different ways to approach things. And if you can strike that balance and that chord, I think you're going to see, I don't think it's a coincidence that a company like Flex LNG carries the valuations it does. And it's not just, yes, the fundamentals, yes, the valuations, but there is something about the accessibility of management.
Yeah. Next question, maybe a shift in topics, and Matt McCleary, you had asked me about this, about the question was, what's the perfect investor? Or what are the attributes? Something along those lines of what makes a good investor, and what makes a good investor? And I feel that we can maybe ask it two ways: what makes a good equity investor, and maybe what makes a good ship owner investor? And I think that those are two good questions for Ole and Bob. Maybe Ole, can I start with you on you've got a very long track record in talking with investors across shipping, energy, oil services. What do you think, with all the volatility, everything that we've just talked about, with all the characters and the history in the sector, what makes a good shipping investor?
Oh, wow, Omar. Shipping is inherently volatile, and it's also, as Robert said here, almost impossible to forecast, which is something that I like as well, by the way. And the smartest person that I know in this space is probably John Fredrickson. And I remember in 2013, 14, I was busy analyzing the US shale recovery, focusing on tremendous growth. Everybody very positive on tankers. Earlier on, people were positive on tankers, but then it became very clear that US shale volume growth was greater than global annual incremental demand for oil, so that it would actually be a negative call on OPEC, which is sort of the typical swing for supertankers and therefore the entire tanker market. And yet, so JF out there ordering super tankers. And I asked him, what the heck are you seeing that none of us can see right now? And he said that, well, at this price, the yard is losing so much money, the steel company is losing so much money, and I just don't see any downside. And I said, well, yeah, but what's the upside? And he goes, well, volatility. And I think that sort of really resonated with me afterwards, because in a way, it boils down to this screen we had there before on red, white, and green. And if you just stick with a very disciplined approach, it's possible. And you take the emotions of thinking you can ever predict the demand side out of it. It's actually not too hard as long as you stay disciplined.
In 2013, 2014, I think we spent $500 million on ships. But I agree. The best investor is well-educated in shipping, understands the volatility, but also understands that they're not the smartest guy in the room in this sector, and that's why they hire management to do something. You do have some investors sometimes who want to tell management what to do, and that's usually not a good recipe. But you do need someone who understands the risk, and I think your point's exactly right. I mean, you buy ships when they're cheap, like the vessel values thing said before, and if you buy them when they're cheap and you don't over-lever, then you can be wrong for a long time, because we all see what happens when that graph goes up. It goes straight up sometimes. And the difficulty is telling investors, especially institutional investors, when they say, well, what's going to change the dynamic? And you don't know. You just don't know, because everything's priced in. It's a really efficient market. But you know that it's below the price of replacement value, or it's below, according to the vessel values numbers up there, and you know that something will change it. And maybe not this week or next year or the year after, but as I said, if you buy low enough and you don't over-lever and you have a lot of staying power, you can make a lot of money, but then you need to sell. And that's really hard when the ships are making $1 million a month to sell them, because it's just hard.
Yeah, but then
what am I going to say? It's so sad,
but then peace breaks out between Ukraine and Russia, and what happens to the tanker market then?
No,
China invades Taiwan, and
or something. We don't know.
Your Cape-sized carrier. What is it looking like now? You think?
And someone said to me at some conference I was at, well, I'm the bear. I'm not the bear, but if there are 2 really good years priced into the assets, I'll take that. I'll take it right now, because 2 years is a long time. And if it's 3 years, I'll let the 3rd year go. That's worth it, because I can be on the beach for 2 years. But I mean, that's the industry. It's just discipline in and out, and good operators, good bank partners, good investors. If you're in pools, good pool operators, good technical managers. All the rest of that is essential. It will not give you an edge, but it's an essential to be in the business, because any one of those things can trip you up. And good relationships. I mean, there are going to be problems. They're physical assets. And there will be problems, whether it's whatever. We know what happens. Ships get held up, and you need to have a partner in whatever sector, in a charter, in a buy-sell situation, in a bank that understands that you're gonna fix it. That's it.
Thank you. And then maybe just on you're flush with cash, right?
No, we gave it back to everybody.
You gave it all. Okay, you gave it back.
We kept a little.
You earned it. As you think about, and this is maybe just to open it all up, we've heard from different panels. We've heard of product, crude tankers, dry cargo, containers, gas. Where do you guys see an opportunity here? Obviously, you've sold out of tankers, Bob, but in general, as we think about the outlook over the next 2 to 3 years, we've all seen the order book figures. It all looks very limited across, I guess it's really just tankers and dry bulk right now. But that makes up, 70% of the global fleet. But in general, the view is you have a very limited order book across conventional shipping. Where is the opportunity? Is there a certain segment that stands out to you guys as very compelling? We heard Tor Olav Troim yesterday talk about how crude tankers look even better than they did back in 03 and 08, which was a record time. So how do you guys think about that?
For me, I thought the first day of the conference was really eye-opening and confirmed what I already believe, which is that vessels involved in offshore have a really attractive supply-side picture, and I think that story has legs. And as we're looking for additional barrels off the coast of Brazil or even off the coast of the Emirates and Saudi Arabia, there's so many projects for drilling which are going to be happening, which are going to need those vessels. And so platform supply vessels in particular are a space which is small, very few listed companies, just a couple of tiny companies in Norway really, and they're very liquid, so that's the problem. But I think that that's going to change. So it might not be exciting for most people in this room, but it's a good little area to take a look at if you haven't yet.
That was offshore oil drilling?
Yeah.
Yeah.
Well, I mean, there's also platform supply vessels which are a little bit more flexible. They can be involved in the installation of turbines as well. There are, as you probably know, other vessels which are kind of like mini hotels where the crew can stay for up to 30 days, CSOVs. And I mean, it takes a lot of work to learn about the different characteristics of the vessels and their particularities, but the shipyards are full for those too. So it's worth taking a look, but I'm still learning about the space, but it seems compelling to me.
Thanks, Ed. Anything else jump out?
I would say one of the things I see a lot is there's so much focus and enthusiasm and motivation about rates and about market trajectories, and a lot of people forget that, I mean, there's a difference, right? There's a difference between what I do and our investors do and what Bob Burke was doing at Ridgebury, right? He was buying assets and investing in the actual assets themselves. We're investing in publicly traded equities. So there's a big difference between where the rates go, right, and where the asset values go, and maybe what your equity return is. And one of the mistakes I see, and it'll be repeated out throughout history because it's human nature, and I fall for it myself, is that we all get super excited about these obvious rate increases or these really attractive markets, right? And we all can quickly recognize the scary looking markets and the scary looking order books. Like the container ship panel earlier, the title of it was like, is the worst over for, like what, is the worst over was like the title. And last year it was basically like, how screwed are all you guys, right? And so I think, you know, folks focus around these rates so much and trying to predict, like, you know, the charters instead of looking at core fundamental values. So we're the most excited about sectors that most people don't like. And so if we could do like a secret straw poll here and, you know, rack and stack your favorite sectors, you know, there might be an inverse selection effect there.
Maybe I can add one observation. I think I've heard on a couple of different occasions here that owners on a panel have stated that, well, I bought the ship at 8 or 80, and now it's you know, 10 or 12 or 110, 120, and I wouldn't buy another one. But yet my stock is trading at, you know, a 30% discount on net asset value. So maybe kind of this, maybe investors in the public market are not quite as stupid as what they're given credit for by many of the people on the panel, because effectively they're saying the same thing as what you know, super tankers or certain other asset classes. They moved up a lot in value, and people patted themselves on the back for having bought a year or two ago, and now the values are at a level where they stated on the panel they wouldn't buy. And yet they're surprised that the equities are at a 30% discount to net asset value. It seems quite logical to me.
Do you mind if I just comment on that? I think that's a really good point. And I think that one of the things which we in shipping are obsessed with, as Jay rightfully said, were the, you know, the kind of the daily incremental changes in asset values and in rates. But actually what most investors are looking at is the outlook. They don't care so much about the supply side. They want to know if the demand's going to show up. And I find as an investor that often if I ask company executives to go drill down into the demand side of what's going to happen for oil or dry bulk commodities, they're nowhere near as well informed as they are about operations and about the supply side. They keep showing these really attractive supply side slides. You know, at every single conference we see the same slides, order book 6-7%, but that doesn't make a market. What makes the vessel demand is the underlying commodities. And I think that's what people I'm in touch with who are investors and other things are looking at. They want to know if there's going to be oil demand. They want to know if there's going to be, what are the demographics in China? You know, that's what they care about. They don't care about rates.
But what kills the market long term is too much supply. The volatility in demand can be drastic, but it's not as long lasting as the
I agree.
volatility in supply.
I agree, but supply is not enough.
Yeah. And NAV is a little bit of a, I mean, NAV is the last MR or VL or picket that was sold to somebody in the world who pays the highest price. So to take that and multiply it by all the ships in a fleet isn't really indicative of what that fleet is worth. I think it's more indicative of what the biggest payer in the market on that day will pay. And then if they say a company's a 30% discount to NAV, I mean, it's a levered company. So maybe it's only 15%, which is probably more realistic of what all those ships could be sold at in one go. So it probably is reflective of what those assets can earn and get a reasonable return.
We have hope, guys, because everyone sounds so disciplined on this panel. When you get a panel full of ship owners that all argue about NAV being like a terrible metric and I should be valued on discounts to EBITDA and I should be valued at 20 times cash flows, then we got to watch out. We got some discipline here, so I think we might be okay.
Easier said than done. But one thing a point I want to make with respect to net asset values and rates is, as an investor, what I like about rates is no one will pay more for a rate than they absolutely have to. If they're paying that rate, they have no choice. Whereas with the price of a ship, someone can be really optimistic, but stupidly so. And so therefore, there's a disparity between those two. And I think that, to me, rates are more reflective of a kind of truth in the market.
We're just price takers as owners.
I completely disagree with that. I had to stir it up a little bit, sorry. Otherwise, they're going to fall asleep out there. You know that as a Twitter influencer, although you don't really look much like anyone I've seen before, but there we go. I mean, a couple of years ago, you had negative oil prices because oil demand fell so fast that you couldn't store it. So a tanker becomes a ARB on a future to delivery price of oil versus current spot, and rates go to the moon. It didn't really have anything to do with underlying demand, yet it triggered a lot of ordering and excitement, although it was one of the biggest short opportunities I've seen. Same thing in 2009. So I think that looking at demand or rates only can be equally dangerous as to look at ship values.
Charter rates especially, I would argue.
Mm-hmm.
Yeah.
So it sounds like we've just uncovered why everybody trades at a discount to NAV, right? There's a clearly, Ole, you started off that topic, but
you know him very well, Omar. There was a guy who said earnings calls are a waste of time. Let's go on CNBC. Market goes up and we make a bunch of money. Market goes down. We buy cheap ships. It goes sideways.
April 25th, 2020. If anyone wants to find the clip, April 25th.
And it was a brilliant model.
yeah. So then, the whole then question that, because a lot of investors will typically gravitate towards, okay, well, the best way to alleviate a discounted valuation is to return the capital to shareholders. Do you agree with that? Should companies be returning the capital, and should they be paying some certain threshold? Should it be a substantial amount of free cash that's generated? Should they retain it all and prepare for the new wave of ESG?
But Omar, how am I going to grow my fleet if I return the capital?
Are there related party fees involved?
Can I ask you a question, Omar? I mean, you've been doing this for a long and distinguished career. How do you see kind of the shipping investor community out there right now? Because being back in New York a little bit here now, it strikes me that there is probably now a bigger flurry of investors again looking at shipping than I think I've seen in a very long time.
Yeah, we have a few in the room. It's been exciting. Definitely, I would say shipping investors have definitely come back in I wouldn't say in full force, but sort of. You have generalists that are just looking at the sector very simply and saying, okay, wow, the supply picture looks very appealing. And while we never know what the demand story is, there's always surprises. But if you can control supply, that's one big check mark that's attracted them.
I mean, cash on the balance sheet, too much cash on the balance sheet is always valued at a discount. Because it's dead money, and investors would rather have that in their pocket because they can make their own decisions. So I think when you get to a certain level, you should always pay it out or buy back shares or whatever.
Yeah, there's something called agency risk, which is probably a bigger factor in shipping than any other industry.
Yeah.
We're probably all in violent agreement about this, I think.
Well, I just want to bring up a point with respect to shareholder returns, which is that there are a lot of investors which are interested in dividends, but it actually sets up a kind of a double-edged sword. You might think that if someone has a regular payout over 50%, generous in a bull market, that they're going to have a more stable investor base. But personally, I found that in the last couple of years in particular in dry bulk and tanker stocks that when a big quarterly dividend is announced, a lot of people don't realize that that's based on the earnings of the last 3 months, and it's not an ongoing thing, and people annualize those yields. And whether they're just ignorant or they are optimistic or a combination of both, that tends to lead to violent sell-offs the next quarter when they can't live up to the expectations. And so ironically, that causes even more volatility than if you have a cheap name which doesn't pay out anything, but it rises.
I'd like to see you back that up with data, because we did some analysis on that same thing and came to the completely opposite conclusion. That companies that are delevered, that pay out 100% of their cash flow in dividends, are a lot less volatile, particularly in down cycles, than companies that do not pay a dividend at all.
Sample size of like 2.
Yeah. Well, I mean, as we're not in a down cycle in the 2 sectors that I just mentioned, I think that's, there's some pretty obvious examples. In particular, Q1 in dry bulk, when the earnings came out, they all cratered. And that was only because there were a lot of people in there that didn't know what they owned. And as a result of that, liquidity went to hell. And now people are just sitting on their positions underwater 30-40%. So, I'm sure that your data is...
I'm not sure if I agree with you again, because there was a genuine optimism at the beginning of the year in dry bulk because of the low order book, but also because people really expected China to come out and reaccelerate. And you had a lot of commodity stocks actually also trading close to an all-time high in anticipation of a big China recovery. And the China recovery has been very poor. And so I think the fact that the stocks yielded 20% at the beginning of the year, and now the yield actually meant that investors saw through that bubble and did not really value it at 20%. They valued it at 6-7%.
Yeah, I think it goes back to people who live in New York. Remember Cy Sims, this guy who sells suits, and educated consumers, our best customer. Shipping isn't predictable. Anyone who's done a budget early in the year, who's exposed to the spot market, you take it out 6 months later, and the budget's irrelevant. You just don't know what the rate's going to be. And so that's inherent in shipping, which means the cash flows and the dividends are inherently unpredictable. So if someone takes a dividend and annualizes it forever, unless it's a company based with a TC coverage, then they just don't fundamentally understand what they're investing in. And we can try to educate people, but that's something we can control. If someone buys it, they're going to get a 40% dividend forever. I mean, and basically anyone who invests in a company with a 40% dividend or 20% understands that dividend's going to change, or something bad's going to happen to the company. I mean, it's not sustainable in the real world.
I think it's less about the dividend itself and the exact structure and the exact percentage shares, and it's more about building trust. Right? Because investors look at these companies and they see the structures and they see the last 10 years, but they want to know that if I am correct and we get this big bull cycle and we get these huge returns, will I see any of this cash? Right? And I think we've noticed in the companies that adopted a very shareholder-friendly returns policy, we have noticed that their valuations, right, whether or not it's a free cash flow yield, whether or not you use price to NAV, all these individual things are just one metric. But if you look at the companies that adopted very friendly shareholder return policies, like Starbuck or like Torm or like Hafnia, we saw significant improvement in their valuations relative to their peers, because investors could know that I'm going to get some of my cash back. And yes, there's going to be investors who aren't very savvy and don't understand that the rates went down, and don't understand that the next dividend is going to be smaller. And then really stupid websites like Reuters and these little headlines are going to say 40% dividend cut or whatever, whatever the Bloomberg headline says. And that's a trading opportunity. And we just said earlier, volatility is the best part about shipping. So I love it. And if you want to improve your valuations of your companies, adopt a transparent returns policy. It doesn't have to be 100%, but it needs to be transparent. It needs to be clear. Investors need to understand it.
Now, volatility is actually an asset class that is viewed as quite an attractive asset class to trade in general. Now, what's not good is an industry that has a poor return on capital through a cycle. But that's not the same as volatility. To have great volatility and a decent return on capital through a cycle is a terrific combination.
And then maybe it's 5 o'clock, so I think we're getting close to wanting that champagne. But maybe just on the final topic of returning capital to shareholders, one of the biggest ones is always, should it be a cash dividend? should it be a share
Omar,
buyback.
5 minutes overtime. This is champagne at 5. I mean, come on.
Oystein Kalaklev, the CEO of Flex LNG, he was very sorry not to be here. He's traveling this week, but he is with us in spirit and actually sent me some questions for you guys.
Good thing I name dropped him, huh?
Ed, first one's for Ed. This is the speed round. Ed, what CEOs would you most like to see become active on Twitter?
Øystein,
That's easy, Robert Bugbee.
never going to happen. I'm taking his place, and I can tell you no.
Actually, but in all seriousness, I would like to see them all become active on Twitter because I think that it's no coincidence that Oystein and Lars Barstad, who was here earlier, are two of the most active, and they are the most authentic. And they share useful information. There's Aristides of Ocanis also, who shares information freely. And these are people who really care about the public image of their company, and I don't think that's a coincidence. And I think that if all CEOs had to be on Twitter discussing things with the two of us in terms of their shareholder returns and other topics of interest, then they would feel pressure to act.
Excellent. So you want them all?
All.
I'll let Oystein know. Bring them all. All right. This last question is for Dr. Major J. I think that's probably you, Jay Mintzmyer. Doctor, because you just got a PhD?
That's a little preemptive, defending hopefully August, September.
Okay. Major, because your day job is in the Air Force?
Yeah,
All right.
church
So
and state.
This is for you, Dr. Major J. Okay, here we go. Order book in VLGC space is higher than bulk and tankers, but earnings are very strong. Right now, spot rate is $100,000 a day with an ARB of $200 per ton for the rest of the year, and the second half looks very good. For next year, the FFA for a 2015 Echo with scrubber is above $50,000 a day, which gives an ROE of 30%. What is Anders, Mr. Hadjipateras, and I, what are we doing wrong?
Objection, leading question. Look, I'm long Avance Gas, so I love that question. But look, people can see the order book, and people can understand those charts like Vessel's Value had up earlier. That matrix chart they put in the end, they needed to adjust for inflation, so I'm glad he adjusted at the end, because that first chart was totally misleading. But the second one he put up that was adjusted for the CPI, I mean, that's the secret sauce right there. That's the most single important chart we've seen at Marine Money. Like the tanker order book chart, like, yeah, cool, we've seen it a million times. The thing he put up there is fantastic. The problem with something like a VLGC, and I am long Avance Gas, but the problem with the VLGCs is the asset valuations. As the BW CEO, LPG CEO said earlier on the conference call, they just don't make sense. The new build valuations are too high. The secondhand asset valuations are pretty scary. And as we had an astute person on the panel earlier, just 10 minutes ago said, when all the companies trade at a slight discount to NAV, the market's kind of telling us something. And look, I'm long Avance, so I love it. I love the management there. Did I say that? I love the management there. Yeah, I expect a nice Christmas card. But they're not doing anything wrong. The market's just skeptical. That's it.
Okay. I'll let him know. Yep. Go then.
Yeah, I think that's good. Thanks, Matt. I think we can wrap this up.
Yeah. That's great.
Thanks to the
Thank you,
panelists.
guys.